Hi everyone, this is Dalchai. I'm at the University Library. Sorry if you guys hear students in the background. Okay, so we are going to be looking at analyzing business transaction part 3, um, journalizing and posting. Okay, so Maya Angelou, right? We're going to go with a little inspiration. Life is not measured by the number of breaths we take, but the moment that we take our breath away. Okay. All right. So the recording process, particularly every business uses three basic steps in the recording process. It's an integrated, an integral part of the accounting cycle. So analyze each transactions, right? So one, we're going to analyze each transaction in terms of its effects on the accounts. Then we got two, uh, enter the transactions information in a journal. And then three, the journal information to the appropriate account in the ledger. Okay, so the actual sequence of events with the transaction begins with the transaction. So evidence of the transaction comes in the form of a source document, such as sales slips, a check, a bill, or a cash register document. This evidence is analyzed to determine the effect of the transaction on a specific account. So the transaction is then entered in the journal. Finally, the journal entry is transferred to a designated account in the ledger. The journal transactions are initially recorded in a chronicle order in a journal before they are transferred to the account. For each transaction, the journal shows the debit and credit effects on the specific accounts, right? So in a computerized system, journals are kept as files and accounts are recorded in a computer database. Companies may use various kinds of journals, but every company has at least the most basic form of journals in a general journal. So the journal makes like three significant contributions to the recording process. Um, it discloses in one place the complete effects of a transaction. It provides a chronicle record of a transaction. It helps to prevent or locate errors because the debit and credit amount for each entry can be readily compared. So like each transaction data in a journal is known as journalizing, right? So to illustrate the technique of journalizing, let's take a look at the first three transactions right here real quick. So we got the equation right here, asset equals liability plus stockholders equity. So um, October 1st, we get common stock in exchange for cash, right? So asset, $10,000, cash increase. Then we got exchange for common stock, $10,000 increase there. Same day we got, uh, we did we signed a note for $5,000, right? So that's gonna be a liability, probably from a bank. So that's gonna give us $5,000 in cash. And then we got on the next day we purchased equipment for 5,000. So that's gonna give us increase in equipment 5,000 in that account, and then we're gonna decrease 5,000 in cash. That's just an idea of how it looks like. So recording transactions in the journal, right? So we're going to actually record that now. So Sierra makes separate journal entries for each transaction. All right, so we're going to put in the date of transaction, account and amount to the debit and credit, and then the explanation of the transaction. Right, so you can see that, you see that right there. Cash, October 1st, cash, debit, $10,000. Common stock, credit, $10,000 for issue of stocks, right? Then we got cash and notes payable right there. And then we got equipment and cash, right? So equipment 5,000, cash 5,000, credit for purchase of equipment for cash, right? So note the following feature of the journal entry: the date of transaction, right? The account, right? So to be debit is entered first at the left. So the account to be debit is entered first at the left, and the account to be credit is then entered on the next line, indented underneath the line above, right? So the indentation differentiate debits from credit and decrease the possibility of switching the debit and credit amount. The amount for debit or with the amount of debit are recorded in the debit on the left side, and the amount for the credit are recorded in the credit on the right side, and then a brief explanation of the transaction. So it's important to use the correct and specific account title in journalizing, right? So bad account titles will lead to incorrect financial statement. So you have some flexibility, but not really. So the main criteria in each title must be appropriately described. Okay, so like for example, companies should use these type of accounts to record the cost of a delivery trucks, right? So equipment, delivery trucks, or trucks. Delivery equipment, delivery trucks, or trucks, right? So if you want to describe something, we really have to be specific. Okay, so the ledger. So posting to the ledger, right? So these are our accounts in the ledger. So the entire group of account maintained by companies referred to collectively as the ledger. The ledger provides a balance of each of the accounts as well as it keeps track of changes in these balances. Right, so companies may use various kind of ledgers, but every company uses a general ledger. So a general ledger contains all the asset, liabilities, stockholders' equities, revenues, and expense. Right. So whenever we use the term ledger, it means general ledger. Okay. So chart of accounts. Right. So the number and type of accounts used different for each company depending on the size, complexity, and type of business. So for example, the number of accounts depend on the amount of detail desired by management. The management of one company may want a single account, like for utilities expense, and another may keep separate expense accounts for each type of expenditures, like gas, electricity, and water. Like small companies compared to big companies, like small companies, they could use like maybe like 20, 30 accounts versus Ford, which like say for example a giant company like Ford, they could use like thousands of accounts. So most companies like list the accounts in their chart of accounts. They may create new accounts as the life of their business goes on. So here's a quick look at Sierra's chart of accounts. All right, so there's the asset, liability, stockholders, revenues, and expense accounts right there. If you guys want to take a look at some examples. Okay, so posting. So the procedure of transferring journal entries amount to ledger accounts is called posting. The posting phase of the recording procedure accumulates the effect of journalizing transactions in the individual accounts. So posting involves these three steps, right? So in the ledger, we enter the appropriate column of the debit account, the date and debit amount shown in the journal, right? And then in the ledger, we enter the appropriate column of credit accounts, the date and the credit amount, right? So gotta make sure we put in the right account name or title, okay? So then we record the recording process, right, as illustrated here. So the basic step is so we would record the process using the October transactions for Sierra right here. Sierra's account is accounting period is a month, so we do a basic analyze and debit credit analyze, and then we proceed to the journalize and post of each transaction, right? So the purpose of the transaction, right, is to first we identify the type of accounts, then determine whether it's a debit or credit that's required. Okay, so take a look at that, right? So we analyze, then we journal entry, and then we hit post. And then right here we take, if you guys want to take a quick look at just a summary. So quick summary of journalizing in the journal and then posting in the ledger. Okay. Okay. Thank you.